I love to study history, but the problem that you can make, even if you're aware of it, right, is you go back and you overstudy like the most recent example. And this is nothing like that, because this is really central bank buying driven, and it's Chinese fiscal buying driven, where if you take a look at like the prior cycles, they had to do with extreme dollar weakness or devaluation, or if you think about 99, 2000, it was kind of the crash of tech, and it was the collapse in real interest rates. You're seeing none of that. The dollar is strong. Real interest rates are very high. But yet the scope of Chinese physical gold demand is already kind of turning the cycle.
This episode is brought to you by my friends at FinChat.io. FinChat is the complete stock research platform for fundamental investors. Beyond having all the standard financial data for more than 100,000 companies around the globe, FinChat tracks company-specific segments and KPIs on over 1,500 stocks. You want to see Amazon AWS's revenue over the last 10 years? FinChat's got it. You want to track premium subscribers for Spotify? They've got that too. You want to see how many stores Lululemon added in China the last quarter? Yes, FinChat has it. FinChat has everything you need to easily track and manage your portfolio. And starting today, you automatically get 2 weeks free of FinChat Pro when you sign up. So go to FinChat.io. That's FinChat.io and try it out. If you end up loving the platform like I do, you can use code TWF at checkout and get 15% off any paid plans.
Welcome, everybody. Trends with Friends, episode something. It is April. It's 4/20. No, it isn't. It's 4/20.
It's April 23rd, Howard. It's
April 23rd. Lewis Johnson is joining us today on Trends with Friends. As always, we have JC in my favorite color for JC, a royal blue.
This will be a navy, Howard. Navy.
That would be navy blue to the old man that's colorblind, Howard Lindzon. But JC's hair looks sharp, looks cutting, looks like a very clean trend line. And speaking of trend lines, no trend line, Phil's scalp, Phil Perlman, Phil Hootie and the Blowfish, joining us, all made up. You got into the wife's makeup drawer, it sounds like, and there's lack of gleam. There is no oil anywhere to be seen on your forehead.
At least less.
I just turned the overhead light off. That's what crushes me.
I put in my bite plate for everybody. I got my show people. Last weekend, I was talking, and there was just a hole showing. Now, Invisalign back in. Yeah, I got to get that screw put in and the tooth put on. I feel like a hockey player right now. And by the way, Leafs 0-8 in the last 8 games against the Bruins. Won a big playoff game last night in Boston. Shout out to my Maple Leafs, the soul-crushing Maple Leafs, who have not won a championship, a hockey Stanley Cup since I was born. That's how bad it is here. Even you freaks have had champions in your life. JC's had hundreds of championships in college. The Orioles were a great team. I don't know.
Ravens.
Lewis, you've had some champions in your life. I don't know from champions. I got a Raptors win. That's not even a real team. And but welcome, Lewis Johnson. He's was one of my great guests on Panic with Friends over the years. Very as COVID set in. And as weird as this may sound, after COVID has supposedly ended, Lewis, you've had a bad case of COVID, and you're just getting over it?
That's my second go around.
It's your second go around. So hopefully you're feeling a little better. Was it a rough bout, this bout?
Just everybody got sick at the house. It was like a drag for like a week. But I think we're coming back. I kept my smell during the whole time, so that's a positive, right? So
that's a positive. We were talking about the smells of New York and the subway earlier, so you won't. Luckily, you will next time in New York. You will get to experience that. So, as we do here, Lewis, we're gonna start with JC top down, taking us through what's going in, and obviously we'll work to you and the business and how you view the markets. But since we're all market geeks on this episode. and we are in the midst of earnings season. I'm going to let JC take it away, and then we'll get you going and introduce you properly. JC, let it rip.
Yeah, I mean, listen, I think it's more of the same. It's chop is what we're seeing, right? And you can go to these charts if you want, where it says the New York Stock Exchange. You can see where my chart is on the deck. I mean, it's just more of the same. So we're getting chopped. So we're below overhead supply in a lot of assets. The equally weighted indexes. Breadth has been deteriorating all year. So there have been fewer stocks making new highs, fewer stocks going up. And the truth is, just the majority of stocks in the market, like just a huge winning group, is in longer term uptrends, but in short to intermediate term sideways messy trends. We've quantified this. This is just the market environment we're in. So in a previous environment where it was advantageous to ride the trend, buy the breakouts, like all of these trend following systems continued to work, sector rotation, all that stuff worked for a year and a half. It was great. But this market isn't that market. You can see it. You can feel it in your own portfolio, right? Kind of just like watching the way your money is moving. But then you can also quantify it. And we do that as well. And you can really see it. Look at, these are closing lows last week. These are the lowest readings in the percentage of stocks above their 200-day moving average since December. When you look at your 50-day moving average, which is more of an intermediate term time, you're looking at the lowest reading since November. So what does that mean? It's not like there's this magic number about the 50-day or the 200-day. That's not really the point. Just think about what that means. There are a lot of stocks in longer term uptrends, fewer and fewer, by the way, as the months have passed. And there are almost no stocks in shorter to intermediate term uptrends. Most of them are in sideways trends or sometimes downtrends, like in the case of Apple or something like that. And it's just gotten progressively worse, right? So the question is not, was that it? Was that we need to see things improving to think that going back to maybe more trend following strategies will be advantageous. We just haven't seen that. Things have gotten progressively worse, progressively messy. So why don't we continue to incorporate the strategies that are best for those messy ranges? And then again, just to reiterate, it comes back to time horizon. I'm talking about the short to intermediate term. I'm talking months, this quarter. That's where my head is at. Bigger picture, I think things remain healthy, but that's what I'm seeing now.
Yep. Phil, go ahead.
So let's talk a little bit. Thank you, JC. That's a great sort of context setup. Let's talk a little bit about what's working, because, that's really what this show's about, Trends with Friends. We have Lewis here, and we can talk about some things that are working. Howard, I know you wanted to talk about Spotify. They reported, they blew it. They're crushing today. They're up big. They reported earnings, and we get a little context from JC on the long-term chart of that. It looks like a five or 5+ year chart there. So what's the takeaway from the numbers this morning, Howie?
Well, I think that this is one of my favorite companies, right? He's one of my favorite founders. We'll get him on the show here. He follows me on Twitter. I am, X. I'm wherever, who's that crazy guy that lost that case that thinks Columbine didn't happen or whatever? Wherever Alex Jones is, I'm at. And I go where the Alex man goes. So it's an incredible company that's underloved, in the sweet spot, I would say, of, kind of underneath the Magnificent Seven. Even today, JC's got this chart up. It's trading right now above 310. So it had this pullback where it probably was meant to have a pullback. And even though we don't trade earnings, or I don't trade earnings, because I'm looking to low stress investing, today's earnings caught a lot of people by surprise. Right? Margins actually went up. There's never been a discussion on the internet where people have said, "Oh, I like Spotify's margins." Every discussion about Spotify since the beginning of time is, "Oh my God, they got to pay the man, they got to pay the music people." There's no way for them to do it. They got to compete with Apple. They got to compete with Amazon Prime. They got to compete with Walmart Music. They got to compete with Tencent Music. And we can see why people think that. Look at Zoom. Look what Google and Microsoft have done to Zoom. We've seen that in tech history, that the wins go to the giants, right? The wins go to the planets, the Magnificent Seven. And Spotify's defying that. So I think it's an incredible story of, first of all, kudos to the people that have stuck with this. I remember buying this in the low 100s with Charlie Bilello, and just saying, God, at $19 billion, a couple of years ago, the replacement, I was just buying it for replacement value. You couldn't buy this thing and build it today for what Spotify did. And we flash forward 18 months, and Spotify right now is trading at closing all-time highs. And most importantly, the fundamentals are improving. The gross margins went up to almost 28%. So I haven't read the details of this, but this is one of those cases where, Phil, the earnings have surprised everybody. And it's not so much the earnings, it is the margins, which have been probably the most closely followed financial margin in the history of tech companies is Spotify's margins. It's a global company. When you think of Twitter or X, you think of angry. Anybody who says, what do you think about Twitter or X? You say, well, it's a place to go to get riled up. And when you think of Spotify, it's a place to go to get whatever mood you're looking for. Happiness, aggravation, politics, news, but generally music. So this is just a great not American story. This is a great European, incredible story with improving financials. And guess what? When you have improving financials and you have a company that's misunderstood and hated, you get gaps and you get gap ups. And this is a really big story in a tape that has very few good tech stories. So, sorry, open that up to discussion.
I mean, it's got some work to do. It's retesting those former highs, right? Yeah. So let's see it. It's really impressive. I mean, how many stocks are pushing up against new all-time highs, right, or even new 52-week highs in this tape? Not many, right? We've counted. You can count them on one hand. It's not a lot.
But the sentiment's also very weak here too, which is good for the stock if it's going to go higher, right? Like
relative strength, Howard. This one's doing really well, while the other ones are not.
Yes,
right up your alley.
Yeah. So you got weak sentiment. You have strong price relative strength. Or underappreciated
is sentiment really that weak?
Well, sentiment is always negative. Oh, what about Apple? What about Amazon Prime? What about their margins? There's never a positive story. What about Joe Rogan? We hate him. What about this? What about that? You never hear a story of like, what about management? They're lazy. They're fat cats. It's a European company. So anyways, I just think it's an interesting story. And generally around earnings, you get a lot of noise. And this is a tech stock that has an improving fundamental story. Apple is a great product in this space, but could care less. If Apple wiped out Spotify tomorrow, 40 to 50 billion in market cap to Apple is a fart in the ocean. It's a little stink on Subway. It's nothing. And so we need the Spotifys of this world for the stock market to work. We need companies that are 10 to 100 billion. We need those companies that go from 10 to 100 billion. And it was there for everybody to take. It was a $15, $19 billion stock, probably on its way to 100 billion.
Can I just say for the record, Howard, this is a great example as to why it is perfectly okay to look outside the United States to find opportunities in the stock market. This is exhibit A. Like you say it all the time, like there's no reason to leave the United States. Like this is a perfect example, Howard. You know.
Yeah. It's just a great story all around, Phil. And I know you love the app, Phil. So
this is first of all, I don't think it's an all-time high. I think the all-time high is over 360 in 21. Am I mistaken about that, JC?
It's not an all-time high.
It was during that crazy right. gappy era where like
that 310 level though, I got to tell you, that 310 level is a big one. If that 310 level goes, I think it rips through those all-time highs like it's not even there. So I think this is actually the bigger level.
Love it. This is, in my personal opinion, this is the most important invention in the history of the internet, right? If there was no...
Excuse me.
If there was no...
Let him go. Let him go. Let
Okay, so here's why. What was the first album or cassette that you guys ever purchased? Anybody?
Partridge Family.
Partridge Family for old Howie.
And by the way,
Lewis,
I think I was wearing
Mountain.
knickers. I think I was wearing
Something with
knickers
Johnny
when I
Cash
bought
in
that.
it. Something with
What's
Johnny
that?
Cash in it. Johnny Cash. Something with Johnny Cash.
Perfect. Johnny Cash. And was that on cassette or LP?
Oh, good Lord. Yeah, definitely cassette.
Mine was
Cassette.
8-track.
JC?
Mine was 8-track.
Big Mountain. Ooh, baby, I love your way on cassette. Single.
Single cassette. There's a rare
Yeah,
piece.
that
For
one,
me, I
and
think
there
it was
was
like
a-
Zenyatta Mandata by the Police. But anyway, so here's the thing. You had to go to the store. You're a kid, right? You're 15, you're 14. You have to collect your money. You have to go to the store and you have to buy one cassette or album that had maybe 8 to 11 or 12 songs on it. Now, Howie, you want to go listen to the Partridge Family. All you have to do is just pull out your phone, put your headphones on, you already got them on, and you can dial up 10 million albums by anybody you want. You can listen to Rachmaninoff, you can listen to John Coltrane, you can listen to Partridge Family, you can listen to the new Taylor Swift album on endless repeat in my wife's car if you want to. Just by pulling up the Spotify app, it's incredible. We've been listening to it nonstop in this house since it came out, by the way. But it's amazing. Plus, music is the best thing in the world, right? What did Shakespeare say? If music is the fruit of love, play on, right? It's the best thing. So that's my vote for the greatest. I mean, Google Docs is fine or whatever, and anything you want to talk about. Facebook was big with the kids back in the day, and Instagram or whatever. My vote is Spotify or YouTube Music is the greatest app of all time because it just brings joy instantly with the greatest. Yeah, that's my take.
Let's add YouTube to this. YouTube for sure. So these are 8 to 8. This isn't one of those 8 to 80 brands. I got to say, I goofed it. I sold it in the mid high 100s. Just because of that, same thing I would have done with Facebook. It's just gone straight back from all-time lows to all-time highs here. These stocks are doing things that I'm not over the last 5 years that I'm just not used to seeing. So shame on me for not getting there. But I got to tell you, at $50 billion with improving margins, you're going to have to change what this company could be worth. When I sold it in the high 100s at 40-ish billion, I'm like, okay, with their numbers, it's hard for me. And, the end of ZERP and the fact that they already are everywhere meant my mental model of what the size of this company could be was, risk reward was okay, 40, 45 billion. I'm out of this. Now at 55 billion, 60 billion and improving margins. And in a world where, they're almost too small to fail against the Magnificent Seven, kudos to Eck and his team for figuring this out. And, I use Spotify almost as much for podcasts as I do for for music. So I don't know if that's an age thing. But right now I'm in a mode of discovering, really great podcasts and I spent a lot of time in the car in Phoenix. So kudos to Spotify. I think they made a lot of mistakes in podcasting along the way, probably overspent. But when push comes to shove and in 30 years from now, all these podcasting little tactical mistakes will be behind us and podcasting's here to stay, like this show. And now they have video. Anyways, we've drowned out Lewis. You may not have anything to say on this one. I know you came on the show to talk about the stuff that you like talking about, but
Johnny Cash is a great contribution to this discussion, by the way. I mean, God bless him.
Oh man, he's the best. Yeah, like what was the last video that they did before he passed away? What was it? 9 Inch Nails cover or something?
Yeah.
Whoa,
Powerful.
That was intense.
Yeah,
that was
incredible.
freaking intense, man.
Well, nobody likes Keith Partridge, so all I can say is I did. I like Danny Bonaducci more than I like Keith Partridge, so that's in the Wayback Machine. He was that troublemaking Eddie Haskell of a kid on the Partridge Family. All right, so let's now get to some of the charts that interest Lewis, because he's been right as rain on this move out of tech into commodities the last 2-3 years. So let's get to it.
This is great stuff. Yeah, this is great stuff. We got one for you that you posted on Twitter the other day, Lewis. from B of A Global Investment Strategy, tech versus commodities. This one just hit me like a ton of bricks, and I know JC's going to have something to say about it too. But we got this chart here that, if you look at tech versus commodities, long term, what's your impression of this?
Yeah, well, no, it's great that you guys caught that and everything. Whenever I do kind of find stuff that I find interesting, I try to share it with like some brief commentary or whatever. But I think that's really powerful. I mean, it gets back to the point that Howard and I guess we started talking late 2020, just about, perhaps being close to a turn. But I mean, I think that's more than just kind of chart voodoo. I think there's a lot of causality there because remember, one of the things that helps tech work is that valuations can expand because inflation is kind of low or falling, so people can pay a lot of money for the things that they're excited about because they have that long duration cash flow, which is where all the value tends to be in these tech stocks. And so, of course, that's typically an environment where commodities are kind of low and falling. And certainly people are forecasting that out. If you look at where we are kind of right now, I mean, that ratio has kind of gotten to these historic extremes. But, the way I'm seeing the world anyway, I see a lot of frankly, pressure for accelerating commodity prices, for inflation expectations that are kind of at the high end of the range, could easily, go higher. And so, and frankly, the commodities, as you may recall, Howard, really kind of lagged gold. And of course, gold's hit a new all-time high, which is, talk about, how rare it is that things are hitting all-time highs at this point. I think that's really the, I'd say the bellwether for like the entire complex. And so as the gold price goes, the commodity prices will go higher as well.
This chart's super interesting. We could talk about forever. So, Phil, JC, what do you see here? I mean, I see so many things, right? Like when I'll quickly here, because I remember Lewis came on during COVID or beginning of COVID, and when we started Panic with Friends, and he said this could be, a cycle move change, and then you had this, and it started to happen, and then you had this revival of tech, which shot past those 2020 COVID ratios, and gold kind of had these Bitcoin broke out and Ethereum broke out and proxies for gold broke out, but gold kind of bounced against highs for like 3-4 extra years to the point where then tech broke through and the ratio kind of flipped. But now this inflation seems to be stickier. Now we seem to be reaching, valuation extremes where, how much can you really say these planets are worth? And now you have rates also, which are not coming in. It's got this extended bear market in bonds, the longest in history. So really tech is done. I mean, I look at the chart and I go, I can't believe tech has continued to fly in the face of the actual, fundamentals. So that's a fascinating.
Well, on that point, I agree, because if you think back about where the world was in March of 2000, we're 2 years past the Asian crisis. Commodities had been in a bear market for 20 years. There was really no sign that would lead hardly anybody to be have a bullish outlook on commodities. I mean, I would say the kind of opposite's true right now, right? You've got gold at a new all-time high. And you've got commodity prices on the move. It is kind of stunning, I think, that that people seem to be pretty blasé with what's going on in commodities, despite the fact that they're moving and the markets are taking it okay.
Two wars. You have inward-looking politics. You have Canada as like a third world banana republic, right? Our neighbor is crazier than Mexico, or more dangerous, it seems, than Mexico at this point politically. And from a workforce perspective. So there's all kinds of stuff that no one's talking about that should be bullish for commodities. And yet that chart still says, man, maybe the commodity trade is not the right time to put that on. But JC, go. What are you seeing?
Go to the. I think I got three charts that I think tell the story here. So the first one, to your point about technology and how technology continues to do well. Well, it's not. I mean, large cap technology, as you can see in the chart, is making new 3-month lows. Small cap technology is making new 5-month lows, right? So technology stocks have not been doing well. Apple, on a relative basis, peaked a while. Apple has lost $500 billion in market capitalization. Think about that. There are only 8 companies in the S&P 500 that are worth more than that. Apple's lost $500 billion in just a few months. That's a lot, that's a lot of money being incinerated. So if you scroll down, to Lewis's point before, you can really see what's happening. And I think that the United States dollar recently breaking down relative to gold is really just another domino, right? It's just the trend that's already been in place. All these other currencies around the world have already been breaking down and losing their value and making new all-time lows priced in gold for a long time. The Swiss franc recently broke down, and now the United States dollar broke down. What, did you think it wasn't going to happen? Right? So it's more of like, when the yield curve inverts, like everybody's like, oh my God, the yield curve inverted. It's like, yeah, bro, you've been able to see it in real time getting to inversion. Like, it's not like you woke up and it just happened. This is like that. Like, all these currencies have been losing their value relative to gold, and now the dollar's also breaking down. So like, it was more just inevitable. So for me, it's less of like this like new thing and more of just an ongoing thing. And then to Lewis's point, gold priced in United States dollars is now making new all-time highs. If you scroll to the next one, we do some extension, work. And if you take the highs in 2011 to the lows, that'll take you to the first target just above 2,400. That's been met. Now we consolidate, see what happens. But I think this thing's got 3,300 written all over it. It's really a matter of when. This digestion here is perfectly normal. Could take some time. I'm not sure, but the trend is up.
Well, one thing, look, I totally agree. One thing that I would add to that, guys, is that I've been following gold since I kind of got into this business 25 years ago, and the drivers behind it are different now than they were, frankly, in the prior 24 years. And the chief new thing basically has to do with physical demand out of China, and that's both retail and kind of central bank demand. And of course, central bank buying is a more frequent and important part of this market that's really expressed itself in the last, really since the Russian invasion, honestly. And it really has changed the supply and demand characteristics because, frankly, if you look at, say, the West, which typically dominated the price action in gold, there was historically a very strong correlation between gold and real interest rates. So when real interest rates were high and rising, because gold has no yield, it kind of drew money out of gold. And so that same force is still working right now. So if you take a look, for instance, at the ounces of gold in the GLD ETF in the States, or frankly, in global gold ETFs, they're falling like a stone. Because most of that's West. But what's interesting is that the Chinese physical demand is really very high. And this is expressing itself in a very sustainable premium in terms of prices in China. And so there's anywhere from a 2 to 5% positive kind of ARB in terms of the market offering a premium price in China. And so the physical is flowing out of the kind of hot money ETFs in the West, and it's going into China where it's getting locked down. And I think that's sustainable. I think that's hugely important. I mean, frankly, the last secular bull market in commodities, the foundation of that was Chinese demand. And the reason, I guess, it's one of the higher conviction ideas that I have is I was watching for some time, the Chinese kind of real estate market, which clearly was a bubble and popped, and it was frankly the biggest bubble. I mean, in the history of the world. I think the Japanese bubble popped. I want to say when the ratios of prices to incomes was maybe 22, 25. In the major cities in China is 52, 55, numbers never seen before. And so both the size of it in terms of just the sheer dollars involved, as well as the multiples, in my mind, it's a catastrophe. We've been talking about that for 3 or 4 years, but we've been watching it slowly for like 10. But the reason I'm highlighting that is if you think back when the U.S. had its own kind of housing bubble, right? The first sign of that was in July 2005 when builder equity started going down on rising numbers. And what would happen, of course, in the next 2 years is we would enter a financial crisis because mortgages are the reserve asset of the levered banking system. And so when your housing's not doing well, your banking system's not doing well. And so I think it's very rational. And so, of course, the gold price went up quite a bit. It went up threefold from 05 to 2011 during that housing bubble. And so, in my mind, that's really the cause of that. The Chinese money that's flowing is Chinese equities aren't doing well. Even they're much more expensive now than they were, but they're not doing well. Real estate's a freaking disaster, and their banks are trading like crap, and they're very low valuations. And so it has kind of a lot of hallmarks of the same kind of financial distress that the U.S. had. And so I think there's a very large bid, and I think it's very durable in terms of what you're seeing out of China. And the premium is maintained in the price.
Yeah, that's interesting. So they love gold here themselves, you're saying?
That's right. Yeah, because
they're putting their
certain
money where their mouth isn't.
Yeah, well, and you can see the evidence of that every day in terms of the premium. I'm kind of an avid Bloomberg user, Howard, and one of the ratios that I've kind of constructed is the price premium that trades in China, and it has been almost consistently $20 to $100 premium over the last 6 months or 1 year in particular.
What? How deep? How far are we into that cycle? So you were talking about the U.S. market, and you were making some implications about the length of the cycle from the conversation of history that you were just having. It was beautiful. How far? And you answered my question, my first question before I asked it about why is this happening? Perfect setup. How far into that cycle do you see us being right now? You said there's still time to buy, but how far into that cycle? Like, we halfway? Are we a third? Are we 3/4? Where are we in that cycle?
No, look, that's a great question, because I think you have to acknowledge that this cycle is starting in a different manner, because I love to study history, but the problem that you can make, even if you're aware of it, right, is you go back and you overstudy like the most recent example. And this is nothing like that, because this is really central bank buying driven, and it's Chinese fiscal buying driven, where if you take a look at like the prior cycles, they had to do with extreme dollar weakness or devaluation, or if you think about 99, 2000, it was kind of the crash of tech, and it was the collapse in real interest rates. You're seeing none of that. The dollar is strong. Real interest rates are very high. But yet the scope of Chinese physical gold demand is already kind of turning the cycle. Now, there is a small precedent for that. If you go back and you look, one of the things that we often look at is stock prices, let's say in gold terms, like the Dow to gold ratio is one example. So basically, the Dow Jones Industrial Average has been underperforming the gold price since 2018. So we're now 6 years into this. So frankly, I've been waiting for more gold strength after that kind of, frankly, leadership change, at least on that index. But one of the things that you did see, like in 99, is that the gold price did bottom and start to kind of quietly rise, seemingly for kind of no reason. And it was only really in the collapse of the tech cycle that really began in September 2000 that you had kind of what I think is where this cycle really starts. It's almost like I was talking to a good friend, John Roque, who's a wonderful technical analyst I've known for more than 20 years. And John and I were debating where we are in the gold cycle. And I said, I don't think we're at the end of the first inning. And John said, they just sang the national anthem.
Wow.
So, in my
Did
view,
they sing it in Chinese or in English? Did they sing it in Chinese or English?
I don't care what language. As long as it's working,
playing,
right?
baby.
As long as it's working, yeah. But let me make this one other point, and you recall this, Howard, is like money in motion. Like you were mentioning earlier, I think, Jordan, that was the example of how much market cap Apple is given up. That's the raw material that flows into the laggards that turns laggards into leaders, is that they have to get that donated market cap as leadership changes. And there is a lot of money that is in tech that I think probably needs to find a more undervalued home where fundamentals are improving.
Well, there's two things related that I want to talk about, and I want to get into silver as well. And you posted another great chart from Capital IQ on silver. Let's just do that one, and then we'll talk about how stupid investors are after that. That's the other topic.
I wanted to just talk about how, because he manages close to $3 billion, how he's positioning it for clients, Phil. So you can dig in there.
Perfect. No, great. We'll definitely talk about that. Well, yeah. So that's a very interesting chart. So you guys are showing the supply and demand balance put together by the World Silver Council, and these folks spent a lot of time taking a look at the underlying physical supply and demand. And so it's what's this 5 or 6 years of deficits. And it's one of the things that makes kind of precious metals different is there tends to be a large above ground stock So what this is displaying is that there's more demand than supply, and so of course it's running down inventories. So one of the things that's interesting about this is that so much of the physical demand is out of China and other places. So it's hard to look at precious metals in terms of that market kind of balance. I mean, it's one of the reasons that we like to look at ratios and this kind of stuff. But silver is silver's a heartbreaker. If you think about it, silver price peaked at $50 in 1980. It hit $50 again for about 3 hours in 2011. And it's now basically half of that price where it hit, 40 something years ago, right? So this has been a very lagging asset. If you take a look at how silver has tended to trade with gold, it tends to follow gold with a lag. And then when the gold bull market gets going, silver tends to kind of explode. So one of the things that we look at is the ratio of how many ounces of silver it takes to buy an ounce of gold. And I want to say we're about 82 or 83 right now. And typically when that level is kind of in the mid 80s, it's kind of a deflationary backdrop. So for instance, when Lehman failed back in 2008, that silver to gold ratio was kind of 85, 86, which is very similar to where it is right now. So it's frankly a very highly deflationary number. We don't seem to have a deflationary context in the market at this point. So I guess it's our perspective that silver has a lot of catch up. And so if you take a look at prior peaks, and this is, I'm talking like decades long in terms of how these things can run if you look historically. But in the past peaks, silver will trade at anywhere from, let's say, 16 to 30 ounces of gold, which is nearly a triple from here. So it's kind of whatever you think the gold price will do. Silver at the peak could do 3 times that if it just trades relative to its history. So silver bull markets tend to be explosive. So I think it can get to really high price. I don't know how long it'll stay there because silver is a wild animal. But yeah, we've actually recently added exposure. We've chosen to do this mostly, Howard, if you recall. There's that class of securities called kind of royalty and streaming stocks. There's about half a dozen of these things. They're very diversified. And so rather than be guys that, poke holes in the ground and buy expensive yellow trucks and have to deal with, hideous foreign governments and so forth. These streaming guys basically, are a form of kind of optionality. Well, they'll have a diversified portfolio of many, many assets, and they'll pay a predetermined price on a kind of forward financing, and then a smaller amount relative to the commodity price over time. So it gives you kind of a diversified way to have exposure to the upside in the metal, which is what you want, while minimizing to the greatest extent you possible some of the operational difficulties of like pulling rocks out of the ground. And I'll make one more point on this. Like a typical gold mine is, let's say, 1 gram per ton. So what that means is a gold mine is 1 part per million gold and 999,999 parts trash. So gold mining is a brutal business for that reason. And so it is a commodity that we have a favorable outlook on, but I think you do have to be careful in terms of how you express that.
Very interesting. I think most important of Trends with Friends is just how we go from Michael Parekh to Lewis to Ohm to what's, I love talking about this stuff because it is just markets. My question is for everybody here, now that I've got this, is we all have different. Phil manages his own money. I manage my own money. JC manages his own money. Lewis, you manage money for close to $3 billion, I think is the latest number. So that's real numbers. And so you have to now take all this stuff. For Phil, it was easy a few weeks ago. JC was talking about energy, and we were talking about energy, and he was like, how do I express it? Well, XLE is the simplest way for Phil, even if it may not be the best, right? For Silva, you're talking about streaming, not digging. So the average person maybe doesn't need to know or does need to know. So we don't want to confuse people. What I think is so interesting about this is in the context of Phil, of how I see rich man, angry man, degenerate man, right? The rich people are starting to move, right? The tech people are the tech people, but the rich people, the ones that buy assets, you can see this rotation. They're not gonna stay in poorly performing assets forever. The rich man is on the move, right? They're seeing what's happening in the macroeconomy. They're talking to their bankers at Goldman Sachs, as much as they may hate them, and they're starting to see the math. they're starting to see the stuff, and you can see the money is flowing. Like China's moving to gold, right? Like, the currencies that JC showed were breaking down for a long time against the dollar. It was inevitable, I guess, that the US dollar did it, right? And China's surviving, even though the real estate bubble was bigger than Japan's, right? They're just moving. So the rich man's on the move. The degenerate man, which is confusing, I think, here, is every man in the United States. It's the zero dated options person. It's the looking for the DJT, the next DJT. It's looking for the next meme coin. I think so far interest rates have proven to not make the degenerate man nervous, right? Gambling. You've got LeBron James representing DraftKings. So they seem placated while the rich man moves. And the angry man seems quite happy using Twitter and just their keyboards so there's something for everyone still, despite, what we see as this movement into, commodities. So when you talk to your clients and they have full portfolios, how do you express this? How do you model a portfolio for this regular person that relies on you for financial services, keeping it all in context?
Yeah, no, it's a great question, Howard. So you recall that we have more than 20 financial advisors here at the firm, and the job of the financial advisor is to know the individual clients, their risk tolerance, their goals, and they kind of interface in terms of creating, let's say, the dish that the client's going to consume. And so we offer 4 internal strategies, one of which I manage, and we have 4 other strategies that we're just kind of incubating at this point. And so the advisor's job is to kind of match those together, right? So our job is to run the portfolios and to really ensure that they're trying to hit the goals, and that we're proud of where they're going and what they're doing. And then the advisor's responsibility is to say mix and match and actually create the offering on a client specific basis. And so the portfolio that the client will consume is going to be varied by that point. But on the strategy that I run, which is our legacy strategy, it probably has 30%, say commodity related, precious metals related exposure, some of which is in streaming, some of which is in public traded mutual fund companies that specialize in precious metals. There's physical wholesalers of precious metals, so we've tried to be very thoughtful in terms of how we've constructed these things, but in that portfolio in particular, where we do have the greatest latitude to look different from the market, we're taking full advantage of that. And I don't know. I mean, I really think it's a turn. I mean, I've been wrong before, but it's important to understand that you can make money in more things than just tech. Like, I remember the last commodity cycle, and I remember watching securities go up 25-fold in 5 years. And so it's not just
Potash.
Auctions.
Potash.
That was one of them. Potash Corporation, Saskatchewan's a good old friend, But I mean, that's real money over a very short period of time. And so I do think that if we do find ourselves in a more inflationary environment, I think the market can suffer, but there are these securities that will be wildly successful and will benefit from that. And precious metals are one of the areas that I would highlight where so we think about that a lot in terms of portfolio construction. Back to your question, Howard, is kind of, we try to identify problems and avoid them, and we say, well, is there something we can own that would actually benefit from that? And then we try to have as many of those in the portfolios as we can stand, and I think it's appropriate for that.
Hey, JC, talking about silver, going back to that silver conversation, and Lewis had said, it's a wild ride, which we all know to be the case. Any thoughts about the price behavior here? Any specific thoughts about the price behavior of silver, JC?
Yeah, I mean, I think Lewis is spot on. I put a chart here, longer term, of how many ounces of silver it takes to buy 1 ounce of gold. I think that's definitely dead on. I put a 200-week moving average to really smooth that out because it can be noisy. So the answer to the question of how many ounces of silver does it take to buy 1 ounce of gold, the answer is historically too many, right? So that should be coming down, which makes sense in an environment where precious metals are doing well. You're going to get the higher beta moves out of silver. Silver is going to outperform. When you go down the cap scale in terms of the gold miners and the junior gold miners, where are the 20, 30, 40 baggers going to come from? They're not going to come from the mega caps, right, that are going to give you 2 or 3 times. They're going to go down the cap scale. We've seen it before. I could tell you a story. So Lewis was talking about how he was buying gold early in his career. I got in this business in 2003, right? It was easy to be a gold bug. All my heroes were gold bug. They were all the technicians, Luis Yamada, John Roque. Lewis, you mentioned John Roque.
Yeah.
That was one of my heroes early in my career.
Yeah, John's the best.
Still is. John's the man, dude, legend. So they're all gold bugs. So it's so easy to be a gold bug. And I thought I was a hero and a genius because I was buying the large cap miners and the ETFs at the time. And I was the man, right? Then I'm on the phone with my boys out in Vancouver and they're telling me about their 40 baggers and 50 baggers. I feel like a schmuck. I'm like, are you kidding me?
All Jewish,
I go from feeling like the man to just like my ego getting smacked in the face because my homies out in Vancouver are crushing it. And I wasn't crushing it like that. So I vowed I'll never again. I'm not making that mistake next time. Well, guess what? This is next time.
I think we're next time. Again, I'm not playing it myself. I'm a creature of habit. And I think one thing lost here is I manage my own money, Phil manages his own money, but we're all open to financial advice. I think people walking around without a financial advisor are the dumbest people in the room. If you're not, a financial advisor is what you make of your financial advisor, just like a great teacher, just like a great coach. You are looking for your financial advisor to prevent you from doing dumb things, not to make you rich. And so everybody needs to hustle. And I have more than one. I don't care if you call them conciliary. It's kind of like on a plane, flight attendants change their name to whatever it is. Change the name of your financial advisor to whatever it is that makes you be a better investor. But get yourself a council of elders, whether it's this show or calling on Lewis and his firm or any of the RAs that we'll bring on here or JC or subscribing for people that can coach you. This is your money. These markets are moving and there is opportunity. And so, this whole idea of not, this is your money. You make the decisions, you make those allocations, but to not have a financial advisor or 3 or 4 in your corner is absolutely ludicrous in 2024 when the world is moving the way it's moving. So a shout out to Lewis for building a firm because this is hard stuff to do. I think the RIA is probably the most interesting sector in a world that's been printing money for decades and decades and breaking rules and making up rules. There are not enough good financial advisors in the world that have seen more than one cycle. So take it upon yourself to build this, this group of people around yourself. Go ahead, Phil.
So I have a question for everybody. This is very related, but it's more about psychology. And I'm just going to call this Stupid Psychology Corner. Because what is going on this week? We're taping this Tuesday afternoon. And, we were talking about the show. Howard and I were talking about the program before. And we were like, fuck, we're taping this Tuesday afternoon. And all of these big tech firms are about to report. And we're before all of them. So if you're watching this, you've seen Tesla report, Meta report, Google report, Alphabet report, whoever else is going. And we're taping this before that. So we're not seeing the earnings. But the reality is that, and everybody's focused on that. So all investor attention, all media attention, all the attention in the world are focused on these earnings. It's all CNBC's talking about. But in reality, they don't really matter that much. They don't matter for, the $5 move or the $20 move that they're going to have after the earnings, if it's a surprise one way or the other. And they really don't matter longer term in terms of what these trends are and the relative weakness that JC's been talking about since long before the last time they reported, right? So if they reported in January, he's been talking about this since December. The weakening breath in this in this sector, in this area. And
can I ask Lewis a question on that front, Pearl Dog?
Yep.
So a big part of the rotation that I think is happening is really from a positioning standpoint, less about, there's all kinds of fundamental stories and everything like that. For me, it's positioning. When you go back to 2008, energy carried a 16% weighting in the S&P 500. Today it's 3%, right? In the Dow, it's a 2% weighting. In the NASDAQ, it's a 0% weighting. So it's more of a lack of exposure, which is really that big catalyst, that big tailwind that can take it. So it's not like, oh my God, the Biden and the Trump and the wars. And like, for me, it's less about any of that and more like the rubber band is so stretched in the exact opposite direction. Like, how much less exposure could you possibly have in these indexes? Like, they're going out, these indexes providers are going out of their way, kicking ExxonMobil out of the Dow. They're going out of their way to make sure their investors don't have exposure to energy.
Yeah.
Like, literally, they're going out of their way.
They're going,
like,
they're going out of their way to get you Bitcoin exposure at the same time. They're going out of their way to get you out of commodities and into digital commodities.
So, by the way, United Kingdom, the FTSE 100 just closed at a new all-time high. And guess what? 0% technology. It's got like 13% energy, 12% materials, all-time high.
Yeah.
Lewis?
Well, no, look, you're asking a really good question, this importance of flows. And this is very real. I mean, I can just share with you. I remember there was an experience in 2003, 2004. I was a large owner in the fertilizer space, which did really well. And I had a competitor who actually made fun of my holdings at the group. He was
like
a year later.
Disturber. He was a shit. There's shit accumulators and shit disturbers.
I will not name names here, but I will do so privately. So in a minute. But no, there were. So this gentleman showed up and he wanted to buy a stock that I had a large position in. And he was with a big company, and if he was gonna buy one share, he was gonna buy $250 million worth. And and that his buying basically drove a double in the stock because nobody else was selling, and so he had to have a seat, $250 million, and that is a lot of price movement in terms of the money coming in because the money has to make the market cap go up, but there's no way that they can have a seat. I mean, that's the way this works once that big machine of the flows turns on. And I can tell you, like, I spent a lot of time talking to friends I've known for 20-something years in these areas. In particular, there's a gentleman who's a very dear friend who works at a large investment bank that specializes in natural resources. And kind of every day, pretty much for the last 3 or 4 months, and I call him and I'm saying, is this locals? Is it new people? And basically for until maybe 2 weeks ago, it was no one knew. And then a couple of weeks ago when it goes to the new all-time high, it was like, whoa, new people showed up. And I was like, well, that's freaking new. That's the first time. That was 2 weeks ago, okay? This is a guy that's been in the industry for 20 years at the largest investment bank in the country. He knows more locals in terms of the people who specialize in this. 2 weeks ago is when people started showing up.
Let me pull up the one chart that expresses all this. Phil, sorry to jump in here. Goldman Sachs. If we could pull up Goldman Sachs, I think we can tell you a lot of stories of like whose phone's going to be ringing when the rich people call to get reallocated in a world that you can't buy it in the S&P. Whose phone's going to ring and who's best positioned right now? Goldman Sachs. Let's take a look at this chart. Goldman Sachs has been in the wilderness for 20 years as tech rampage. They wanted to be DJs. They wanted to be tech people. I can't tell you how many fintech companies they thought they had to be in. We are at a moment in time, and the moment was added to yesterday, Phil, with the Betterment divestiture of Marcus. I can't tell you how
Marcus Invest. Just to clarify, Marcus Invest, their robo advisor arm, Goldman jettison back over to Betterment. They're just getting out of that business.
We can all call Lewis. I can hire Lewis tomorrow and say, Lewis, build me your portfolio. Luckily, I can do that. And I get to chat with Lewis all the time. Guess who rich people have to call? Goldman Sachs. Guess who was terrible position to take that call until very recently? Goldman Sachs. Why? They were fucking trying to be everything. They were trying to be an AI company. They were trying to be a data warehouse company. They're trying to be a quant company. They're trying to be an ETF company. They're trying to be an RIA. And most importantly, they're trying to be a fintech company. And guess where that got them? 20 years of nothingness, right? 20 years of chasing and panicking like every other dumb investor or every other investor in the world. Okay, I remember early fintech, Phil and JC, when I was discovering, the world's going to have another E-Trade, the world's going to have another Schwab, the world's going to have another this. And I felt like I was the only one doing it. And then about 2013, Goldman Sachs started showing up on cap tables. I remember it with Plaid, which is kind of the back end banking as a service, hook your account up to Plaid. And I remember seeing Goldman come into the cap table. I'm like, wait a minute, the hell? Who needs Goldman Sachs on a cap table of a couple $100 million company that's going to be disruptive? And I said, they let the hen into the hen house. Goldman has been for such a tiny market cap of all their time the last 10 years, they could have been back to their old ways of pillaging. Guess who's reminded themselves? Guess where we've come full circle to? The pillaging era of the capital markets, people, is at hand. Goldman is at all-time highs. Interest rates are strong. People don't know anything about how to get their hands on these positions. There's wily old veterans like Lewis still hanging around the hoop that know how to put stuff on. But 99% of the population that's been out of commodities for the last 20 years, and the bottom being negative oil that JC quoted yesterday, 300% down on oil. I don't know if things could go down 300%, but they did that day. So we had the absolute bottom in commodities with negative $30 oil. If we could take away anything from this conversation, Lewis and Roque have said we're at the national anthem of commodities. Look what's happening with gold, US dollar. Look what's happening with China buying gold. Look what's happening with the S&P having 3% exposure to energy. Look what's happening with the fact that Goldman Sachs is cleaning their balance sheet and their mind share to focus on capital markets, pillaging the stuff they're good at, taking rips of 3 to 5% to get chasers into gold and hard to get at assets around the world as the world closes and shrinks and two wars rage on. So I go back to the three Gs, Goldman, Goldman Sachs, and Google. The reason Google's hanging in is it's not really a tech company. They're a service and apps company, right? Android is Android, right? They're updating it. Maps is Maps. Gmail is Gmail. YouTube is YouTube. Google is a well-oiled media advertising and app machine. So they're not going to be as affected as much by this tech downturn as long as the economy stays strong, because where do they get their money? From ads. So I think these three charts still show that there is really a lot of strength if you know how to look for it in the right sectors. And it's the three Gs over the three Qs. And so Goldman's a sneaky, I don't know where Lewis or JC you see about this, but them ditching Betterment. They probably gave Betterment a couple, 10, 20, 30 million bucks to offload this. Is not really going to change Betterment's business model. It's a terrible low margin business model, and most people should be at Vanguard. But kudos to Betterment for outlasting Goldman. These are all good signs that Goldman has gotten the message, and that Goldman's going to get back into the business of pillaging nations and countries as we move into this commodity boom. So I think all signs lead to like really big new trends emerging from this shrinking, angry world. So, I think we'll be talking about this for a while, Phil.
All right, I got a commodity play for you guys that is we're running out of time. We got to like half of what we were going to talk about today, which is always great because it means we're just having a really great discussion. And Lewis, that was fantastic. Everything and more that I was hoping for in a discussion with you today. But I got one more for you guys. And this comes from Riley Roseby over at Trends with No Friends. And so what we do here, Lewis, is we're looking at stocks with Trends with No Friends. We're looking at stocks that have a very small following on StockTwits that are behaving incredibly well.
Yeah, I saw that the other day. I saw that list the other day. I think that's great.
It is fantastic, the gems that we're uncovering. And so one that he sent us over 3 today, but we really only have time to quickly discuss one of them. He sent us over this one. I never heard of the stock before. It's got all of 471 followers on StockTwits. It's called Badger Meter BMI. So this is
that's
not
a water meter
index.
company.
What's that?
Yeah, it's a water meter company.
It's a water meter.
I love that
company.
he knows it. I love that Lewis knows it.
It's ridiculous that you know that company. By the way, $5 billion. It's not a tiny company. It's over $5 billion market cap. It's just blow. I mean, look at that chart. Whatever happened, 4 or 5 trading days ago, looks like it was definitely good news. It was probably a crazy number with guidance. They probably have small number of analysts covering this, but they have to raise guidance and get into that whole standardized unexpected earnings dance that they do early in cycles. Go ahead, Rob. Go ahead, JC.
This is an Eddie Elfenbein stock.
Does Eddie own this?
No, but it's like one of the things that he would own.
It's an Eddie Elfenbein stock. Exactly. It's just like all it does is crush it and nobody knows about it. It's unbelievable. 471 followers and look at this thing go.
Yeah, again, it goes to that, as JC has been saying, and I'll let Lewis, sorry, as JC has been saying, the math is not good. There are too many trends that were in vogue for too long with too many friends. The math is starting to unwind. The great news about trends with too many friends that are ending and bag holders is the new trends emerge with no bag holders. They emerge with fresh shareholders. They emerge with stories that really are just about to be told. That's how the markets work. It's all storytelling. The difference is on a lot of these commodity companies is the market caps. You got to be really careful. They're not endless growth machines. So, Lewis, how do you deal with that in an era of how do you know when these stocks when kind of businesses like this kind of move very quickly and the market caps move quickly? How do you manage those positions when there's not endless growth?
No, it's definitely not endless, Howard. But I was there at the bottom of these things. In 2002 and 2003, there was one of the fertilizer stocks I remember. It traded $1 million a day, and I had a $250 million position in it. And I got a lot of pushback from my portfolio managers, and they said, if nobody else but us sells this, it's going to take us, a year to sell it. And it was super cheap, and I had a lot of high conviction. I won't regurgitate the whole story now. 5 years later, it traded $9 billion a day, and the stock was up 25-fold. So miracles can happen just like they've happened in tech. You'll see them happen in this cycle. And I can tell you one of the things that I got right that I was, I suppose, proud of at the time was I kept essentially bucking myself up and saying the most important thing I can do at the beginning of a huge cycle is to be really bullish. And this is when I was at T. Rowe and I had billions of dollars of positions on. And I was, in fact, in my opinion, I was the most bullish person on the planet that I knew of because I was choking on these things. And I remember it was somewhere in 2007 and 2008. And I said, I wasn't bullish enough. I mean, I promised myself that I would be the most bullish person on the planet. And I really tried hard and I wasn't, because I was stunned at what took place. I thought I'd make like 5 or 6 times my money, and some of these things went up 25-fold. It was just staggering. And so I think it's important to be humble early in these things in terms of where they're going to go. And there's a lot of volatility and path that these things are going to take. But if my view is correct, that this is, like John Roque was saying, that they're just singing the national anthem, because tech is only starting to bleed out now. That's where the money's going to come from. And so yeah, I mean, I'm very excited about it because I kind of cut my teeth on that cycle. And then, and as you know, it's been tech forever, but it does feel like that's changing. And I think it's, the discussion in terms of like cautionary and valuation, that point will come later. But the bigger thing is just to kind of find the things that you can believe in, that have reasonable valuations, that you can defend good balance sheets and stuff, and just freaking be patient.
Phil, since we got him here, can I ask a few more questions, unless you have to run?
Beautiful.
Lewis,
it's great discussion.
So we were talking about the dollar. So now that gold's breaking out relative to the US dollar, some people will say, well, that's the final straw. It's already been so strong. What do we see here? What's your best guess? We flash forward a few years. We're sitting here talking about the US dollar. And where do we see it going, and how does that make you nervous or excited at any level?
Well, of course, it's very easy to create a bear case on the dollar. A lot of people have tried and done this. I'm not in the like dollar's going to go to zero camp, Because I mean, think back about what's driving this gold price right now. It's a mathematical fact that there is a premium that is endured in China, and it's the collapse of their housing bubble that is driving the funds into this. Same thing happened when we had a housing bubble. Okay, so, but the thing is, the Chinese checkbook is enormous, and it's a persistent bid, and it has driven a large part of this move with Western investors being not only not present, we're selling.
Yeah.
Western investors are selling into this.
Yes.
Okay. And so what I've asked people rhetorically is, when the West stops selling, what is the price action? I mean, it's like everybody's buying, nobody's selling. What's the price action look like? We haven't seen that. I think we will in time, but so number one, I would say that. The second thing, it really is, I think, important to think about currencies, because these are political instruments, Howard. And so China runs the world's biggest trade surplus, has for a long time. This is very much a political issue, whether you're a Republican or Democrat, like in the States. So as the Chinese currency is losing its value against gold because the gold price is going up, how do we not respond in kind without increasing our, say, unemployment or the scope of manufacturing unemployment that's here in the States? I think we're at a point politically where it's very difficult to do that. So basically, if our largest trading partner and kind of global competitor has decided that it's willing to let the value of its currency go down, which is a mathematical truth against the gold price, how do we not follow in kind? And what are you thinking? Like, of course we're going to follow it. I mean, how do we not? That's why gold's going up in Swiss francs. I mean, because they have to follow as well, because we all live in this interconnected world. And when someone essentially tries to steal a march on you by lowering their position on the cost curve by decreasing the value of the currency, I mean, how do you not kind of follow along with that in a competitive world? So frankly, we're all kind of getting drugged, perhaps in a direction we'd rather not go, but that's the direction we're going anyway.
Wow. I mean, again, I think this is why Goldman and capital markets companies are cleaning up. Goldman knows something, right? They're finally making decisions that are saying, you know what, we could be an RIA business, but we're going to miss this 5% trade selling people gold that they can't get from China later on. I think they're reading the tea leaves themselves and seeing this position, as are probably some of the other investment banks. And then with interest rates. So interest rates, we talk about this. We have tech people on all the time. ZERP, ZERP, ZERP. And these young kids, what do they know? They know ZERP. They know 2%. And they go, oh, I'm waiting for interest rates to come down. I'll never be able to afford a home at 6%. I'm trying to teach young kids to get out of that mindset, because the world at 5% is a pretty damn good world. The world at 6% is still a pretty damn good world. Because I remember buying it on the way down, my home at 6%, thinking, oh my God, I got to lock that shit in. So how does interest rates, and you have clients, you have a lot of clients, and you talk to clients. I only talk to myself and Phil, but how do you talk to clients in a world that may never see ZERP again? I don't think we'll see ZERP again. It was an experiment gone awry. The biggest worry, I guess, I have, Howard,
in terms of bonds, it really comes back to portfolio construction, because we used to live very clearly in a world where they were negatively correlated, right? Because real interest rates were falling in an ever globalizing world. And so that put downward pressure on inflation, and it was a tailwind to bond prices. And so every time there was a economic hiccup or a credit event, the Fed could be counted upon to cut interest rates, which would bolster the price of, let's say, long-dated risk-free instruments, which were U.S. Treasuries. And so it was a wonderful thing for me as a portfolio manager or creator of portfolios to know that you had that negative correlation there, because it was a wonderful risk management tool. And frankly, I'm not sure that world exists anymore, because there's been much more positive correlation, right, in terms of as the bond yields back up, which is not great for bond prices. This is not a great thing for equities. So frankly, what this really makes the argument for is a direction that we've been messaging for some time, which is that you want to have more exposure to things that kind of benefit from that potentially disruptive trend. I don't know if it's going to continue in terms of higher yields, but really that's the commodity complex. It's companies that profit from these higher commodity prices, because if bond yields are going to continue to rise, something's going to make them do that, and it would have to be higher inflation. Higher inflation is a good thing if you are a company that pulls rocks out of the ground or pulls oil out of the ground. So there are ways that I'm confident that we're going to be able to get positioned in terms of publicly traded equities that will do very well in that environment. And just take a step back and just think about this big picture. So you remember, Howard, you've been doing this long enough to remember. So the NASDAQ fell 82% from 2000 to 2002 and then chopped sideways for a long time. So during that period where tech stocks were horrible, the natural resource stocks went up, 5 or 10 fold. There was a place you could make money. And it was the fact that the resource stocks were working were what was pummeling the tech stocks. So I do think that we're getting close to kind of shooting on the other foot and so forth on that. But I do believe there is a solution in public equities. I just think that the nature of the cycle could be changing.
Amazing. Phil, amazing. Do I miss anything? Do we miss anything?
Beautiful stuff. No, this is great. Great discussion. Lewis, thank you so much for coming around today. And also for just putting up with Howard in general.
No,
we sat on a fishing boat together in the heat. So he's seen me in he's seen me out of my element. He can vouch that I'm
smelling real bad.
You got to come down again, Howard, because we got to get out there and do some more
yeah,
fishing.
the summer is the good tarpon fishing, so we're going to catch one. We haven't caught a tarpon together, but we've hunted them. All right, well, another episode of Trends with Friends in the hopper. Thanks, Phil. Lewis, we'll have you back. I think we've got a clearer picture of what's interesting is the 60-40 portfolio. It's not really 60-40. I think there's just the whole world's in that 60-40 portfolio, the Ray Dalio trade. And it's what you do with that 40 that's been locked down in bonds in that trade. Like you said, that decoupling has been a mess, right?
Yeah.
So there's just a lot of mispositioned capital in bonds and underposition in commodities. So we'll track this, have you back in a few months. Phil, thanks for running the show, and we will see everybody next week.
Adios, guys.